How are we doing? Bear in mind that trading heavily leveraged, risky. Do not trade your hard-earned money until you have a track record of success using brokers' play demonstration account. Yeah, you weren't getting sound because we hadn't started yet, but here we are. How's everybody doing today? Outstanding. Good, good. So, as typical with, welcome. Big welcome to you. So, today what I want to talk about, the webinar is entitled something to the effect of the dangers of following indicators versus anticipating indicators. Alright, and this is a pet peeve or rather this is a common point of disagreement for myself, as well as an educational webinar. And the reason is this, alright? Indicators are fantastic until they don't work. Okay? As is a lot of sort of technical analysis and trading methodology, so to speak. Alright? But I think it's important to remember that most, if not all, indicators, and when I say indicators, I'm including, but not limited to, oscillators, so RSI, MACD, stochastic, CCI, you name it. Alright, I'm going to talk about the more traditional ones. And then I'm also talking about things like moving averages. Bollinger Bands is a bit of a gray area there, not so much, but so Bollingers, maybe not so much, but certainly moving averages. Pivots, not really, because pivots are ahead of, they're reactive to price in that they generate themselves in the previous 4-hour candle, the previous daily candle, the previous weekly candle, previous month, and then they projected forward for that trading session, that trading week, month, etc. Fibonacci is both reactive and predictive all in itself. Alright? But I want to talk about the common ones, like moving averages and oscillators principally. You know what, I haven't used it enough to really make a remark on that, to be honest with you. So, yeah, I mean, I wish I could see either way. I'm just not that well educated on it. Sorry about that. Yeah, I apologize. Okay, now, so here's the thing, alright, is that when one looks for a trading methodology, a trading system, so to speak, I think one always wants something mechanical, something that you can, something that takes the subjectivity out of your hands, so to speak. All right, would you agree with that? And I'm saying this when I'm rooting this back to when one starts trading, but I think the natural inclination is to obviously want something a little more mechanical. So why have all these indicators if they're not really gonna forecast anything? All right. So for example, if we have time, we'll look at it. We can look at a commodity chart here. I lost my train of thought there for a minute. Okay, so all right. So when I first started looking at when I first started looking at trading, all right, here's exactly what I looked at. Okay, somebody had something like this. Okay, then they had an envelope like this, all right, which is just a series of moving averages. Okay, and the basic theory was, well, when the moving averages have all crossed in one direction, then price is going to trade in that direction, and you can only trade in that direction. So, for example, here, it's 5 EMA, or rather it's 10 EMA through 100, 5 EMAs apart. Exactly. All right, it's not rocket surgery. Okay, when everything's folded over and established, then you can only trade when it comes back into the moving averages. And it's actually not a bad way to go trading, believe it or not. I'm not a big, it takes a lot of patience, and I like it on a 4-hour and a daily, but it's not a bad way to view the market, because you're trading trend, basically, or changes of direction, and then pullbacks to support or resistance within the context of that, which is effectively what I do anyway. Okay, so it's a very visual way of doing this. All right, and then what they do is something like this. And then the other little trick was this, and then they put CCI on here, and I'm not gonna put it all in here, but then this was sort of the theory, is that one has the 100 level, the 200 minus 100. I'm getting to a point here, so bear with me, please, and I'll bring you some value to this webinar. Okay, so then the basic theory was like this. Okay, when price has, or when the moving averages have all established each other in one direction, then when the CCI comes back through 100 and then crosses down through it, it generates a sell signal. So that one would be all the moving averages in one direction, crosses back up through 100 and then down. That's your sell signal. Okay, and here, you don't really get a buy signal at all through this. It's too cloudy. All right, and one's generating a mechanical, and then there were other parts of it where there's Bollinger Squeeze involved and some other little things, but it was very system, very mechanically orientated, and honestly, it wasn't too bad. Okay, it wasn't too bad, but it did catch it sometimes buying at the absolute top of the market and selling at the absolute bottom of the market, as if one had picked the bottom and the top incorrectly on purpose. Okay? And here is the reason why. Okay, and here's the reason why. I'll just bring up a fresh chart here. Okay, if we're looking at our price action laws or rules, so to speak, okay, we've done we've done many price action webinars, so if you lost, I'd encourage you to go back and look at some of the recordings I've done. Okay, but I'm going to use our zones, so to speak. Alright, I'll just scoot this puppy over a touch. Okay, if we're looking at our basic price action model is as follows. If we're looking at everything by us, if we're looking at this price action, right, this is a green zone of this rise, and our green zones, I'm just going to look at them as fibs, and we're not even going to look at market fractals, nothing. Okay, think about this think about this as one time frame, pretty linear, sort of one-dimensional market. I'm just talking about this in an ideal scenario for you to get the concept. All right? So this would be a green zone of this rise. Change the color here momentarily. Good morning, Cliff. How are you doing? All right. And then we go through our little red zone here, moving up. So this would be our little red zone broken. And we've done this one 1,000,000 times, right? And then we'd have our little green zone of this swing rise. Okay. And then it breaks our little red zone. And then we always have the move fib green zone, right? The fib of the entire rise. You guys with me so far? Okay, and then price is likely to do sort of something like this to get down there. In other words, this is a green zone of this swing rise, and this is a red zone of this drop. Well, I'm gonna elaborate here in a sec, Jack. This is kind of the this is. It's all going to sort of come into context here in a minute. All right. So then we have our little move fib green zone, a little swing red. Do you guys understand how these areas are generated? It's really not difficult. Red zone. Up to the double top, bounce. That's a swing green, etc. Okay. And up she goes. Right, and it has a little swing red. Does everybody understand how these little bounce points were generated? It's all swings of things. Right? These are all just buy and sell pivot. These are all just not pivot zones. These are all buy and sell Fibonacci zones. Right, so this would be, say, a 382 to 618 fib of this rise. This would be a 382, 618 fib of this swing drop, and so on and so forth. I'd encourage you to go back and look at some of my past videos to understand it. All right. The issue is, the thing I want you to get is this. Okay, is that if something is going to roll over, you're likely to do this. Okay, bounce, bounce, lower high, lower low, and that can either then start a new downtrend, or potentially just a fib of the rise before resurrecting the uptrend. But this lower high, lower low scenario is what can precipitate the start of a change of direction. Okay, that's the important thing to realize. So these little red zones, even though they're broken, are potential reversal points, like this one is. Does this make sense? Okay? Excellent. Thank you. All right, now, I don't think this is bootcamp trading. I think this is standard. This is just price action 101 here. Yeah. All right, now, here's the tricky thing. Is that if one is using, for instance, let's say a 512 or like a 5.8 on the moving averages, or even a stochastic, the problem is this. Check it out. I'm going to blow this up. Okay, so I'm gonna do this as if price is reversing. Okay, now obviously, if there is a massive red zone here, it's behaving like this for a reason. Okay? Alright, so now this is our little green zone. In other words, if we're buying, we want to be buying as close to that green zone as possible, and if we're selling, as close to that red zone as possible. And the reason for this is that if we buy as close to the support bounce as possible, we can move our stop to break even or there and thereabouts. So when or if it is going to reverse, the worst case scenario for us is a break even trade. That's the whole thinking behind it. Because in trading, all we can really guarantee ourselves or predict with any level of real certainty is a reaction to a support or resistance area. So you want to be buying as close to that support area as possible in order to aggressively move your start to break even, or at least that's my philosophy. So if this distance here from the buy point to the potential fail point is less than, say, 20 or 30 pips, I don't take the trade. Because I don't have a solid edge in which to protect myself. Alright? Now here's the thing about indicators, and this is the crux of the webinar. Let's say you're using a moving average crossover sort of system. Alright, and what I'm saying is, if the failure point of the trade is less than 20 pips away, I don't take the trade, even if I think it's going to work. Yeah. Just over time, it'll beat you up. Okay. So anyway, let's say using a moving average crossover here of, say, a 5 and an 8. Alright, it's going to look like this. Okay, your 5 EMA will do this. So say you're saying to yourself, oh, I'm going to use the moving average crossover to put me in the trade. It's going to do this. Okay, and then let's say you have this. Alright, so when you see this cross, right, so this would be, we'll call this the 5 EMA, say 8 SMA like we use, cross, that's going to put me in the trade. So we'll put this as moving averages. Pretty common way of doing things, a crossover methodology. Alright, following indicators. Well, when this crosses, price is realistically at the close here. Isn't it? Right? It lags like crazy. Okay, now let's say it changes direction again. So now let's say you want to get in the buy side. It does this. Okay, it's not particularly well drawn. Okay, and then the buy side, when this is realistically crossed, is here. So you're telling me to get in the short, it's put you in exactly where the market would get long, and to put you in the long, it's put you in exactly where the market would get short. Yeah, but you can get stopped out 10 times over. This is what I'm saying, is you want to try to avoid this. So the conundrum is, okay, so the conundrum is, oh, but David, why don't I just buy at support and not worry about the rest? Because it's nice to have some level of confirmation around your buy and sell areas. Even at 10.20 is going to probably be just as lagging. You're going to get less false signals, but you're going to expose yourself to a lot more risk. I like to use, like for me, I like to identify strong support and resistance. So for us on the euro today, it was 30.50, and then we had sort of 31.20, which looks to be broken. All right, but you know what I like to do around my support areas is identify a support area, and then watch price action. So the first component to an uptrend would be a higher low. So if it gets down there and I start to see this sort of thing, creating higher lows at my support area, you know, we might be doing something like that. So then I'll watch a higher low through here, and if my stochastics are ready to roll up, not rolled up, ready to roll up, you've got to anticipate the oscillator or anticipate the moving average right where it's happening. Okay? It's the way you use it, Boyke. It's the way. So what I'm saying is, if this crosses, look at where it's getting you in. It's getting you in at exactly the wrong spot. This is what I'm trying to say. Is that you cannot follow indicators. You are going to kill yourself in the long run. You cannot sit there and say, such and such has crossed up, my stochastics are blah, 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 da, da, da. You're reacting to what has already happened. Okay? You're going to die. It's not going to work out well. Exactly. Exactly. So I'm going to offer, right, so let me identify the two problems, and then I'll switch over to solutions very quickly. All right. So now same scenario here. Let's say you talk about oscillators and using, for instance, stochastic. Stochastic's going to do almost exactly the same thing. Okay. When I look at, depending on speed and sensitivity of your stochastic, obviously, RSI is the same sort of thing. But when I look at stochastics, I do not look at the crosses as signals at all. I rely on when basically saying, I do not want to trade against the direction of the stochastics when it's crossed down what I call into the trade zone. So I don't want to trade against it when it's here, or against it here, or against it here. I don't care about anything else. But the problem you cannot follow a cross like this and think you're going to short it. Because it's going to put you in at the green zones on the short side and in at the red zones on the buy side. Do you guys I want to make sure that everybody understands why this is a poor idea in your trading. So, I mean, we've all experienced it, and it's more for a newer hand, I think. But how many times as a newer trader did you hit the buy side and it went short almost exactly when you hit it? Like, every single trade you took, you were 20 pips down. Every time's a coconut. Alright? And this is the reason. It's because one's reacting to the market as opposed to anticipating it around your key areas. You're following indicators. You're not anticipating them. Okay? So now, what's the difference? Alright? Well, the key thing is, for yourselves, is you've got to locate where a green zone would be. Alright? So, let's take it, or a red zone for that matter. Alright? So let's take a quick look at the pound, for instance. Alright, and I've been watching this little trend line for some time. cruises through like this. Okay, and I've got a weekly R2 at 55.77. Okay, so touch, 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 and we're going to be there again. Okay, allow for a little bit of overshoot, and it's my prediction that we're going to come off here and at least drop about 100 pips in the next 24 hours for a short trade. All right. So, how, if we're not going to follow indicators with this, well, the fact that what I've noticed is that price likes to retest crossed 2155 MAs. I could take these off and be just as happy. The bottom line is I know that this is a resistance zone that should precipitate a move down to about here, which is clearly a support area, and I'll show you on the 4-hour. Right? We should get a move back to this stuff at least based on this area. I mean, is that sort of a fair way of looking at things? So kind of from here back to here. That's money right there. That's 120, 130 pips. Okay, so where would our potential failure points be? Well, the whole point, Leonard, is that I'm trying to work out. I'm going to try and demonstrate how you can mitigate some of this risk of being late or being early, right? I think it's important to realize that. One's not going to be perfect. You know, as much as we can try, you're going to be perfect and hit it perfectly sometimes, but there's going to be a lot of times where you're just not. Okay? And you kind of got to live with those. You've got to live with those with stop loss. You're going to get knocked out sometimes, and then it's going to work. I mean, you've got to kind of take the good with the bad. You know, saying stuff like, oh, the market's so manipulated, I can't trade it. It's kind of defeatist. Like, roll with it. Like, take the good with the bad. Add to your winners. Cut your losers quickly. You'll be fine. All right? So let's say now that we're saying this is our short zone. Okay, we've identified that. We've basically worked out a trade plan. Okay? So we are going to look to get short in this area because it is the trend line. It's weekly reversal pivots. The pound is very extended from several days gain. It's also the 200 EMA. So now the question is, where would the first potential failure point be? So if price is going to potentially do this and get into that green zone, the first failure point would be a swing fib of this area. So first failure point would be here, and then sort of down here, and then our profit area be here. Now, these first two spots are simply areas where not to trade. Yeah, I think it could maybe go to 57. I don't think that's crazy. Alright? So, I'll get rid of these a sec. But this would be our profit zone. Okay, so basically looking for like 56.40 short for about 55.10, 55.20. Okay, now if we're going to wait for a million crossovers, and I should have put a stochastic or something on this, chances are we're going to get in like down here. And this would be the first point where price could rise. So if we're wrong, we don't want to get in there, correct? So my ideal scenario for this is an hourly chart. On a 15-minute, it would look like this in that area. Green, green, hits it, red. Okay, so we're not even trying to predict where it's going to roll over. Hits this area, turns some red. Okay, comes down a little bit, and then we get green, green. And it starts to show a lower high. Now, we don't know if it's going to be a lower high. It just starts to show one. You know, and then the next candle kind of starts out red like this. And at the same time, the 15-minute stochastics are doing this. Make sure I draw this stuff like I want it. Kind of come down, and then I made the second little rise like this. Okay, they haven't crossed over, but they're in position to cross over. Alright, and there's a lot more I'm not going to have time to cover today, but this is the general gist of it. So now the 15-minute is showing a lower high, so then what I would like to do is I'd like to drop into a 5-minute to see what we're doing here. And then I'd like to see the 5-minute basically doing this. With the 5-minute stochastic having cycled and ready to cross down. So now I've got a break of the low on the 5-minute, which is potentially the low on the 5s like this on the 15, and a 15-minute lower high at our resistance level, because remember, a downtrend is defined by a series of lower lows and lower highs. Alright, so a lower high is the first component to a downtrend. It's the fastest thing you have outside of taking it right off the resistance. Make sense? However, the oscillator indicator or whatever you're using is getting ready to comply with a rollover at that level. Yes, there's some subjectivity to it. There's going to be some fake outness to it. But you're doing this at resistance. So when it shows this lower high on a 5-minute, breaks this lower low and then comes back with the stochastic kicker at your resistance with a 15-minute lower high at your weekly reversal pivots. Alright? Yeah, but you're filtering it with these other things. You're filtering it with these larger term levels. And I'm not saying to you, put a stop here. I'm not saying to you, short here with a stop here. I'm saying short there with a stop above that resistance. But you're just trying to improve your chances of timing the trade by using price action clues at levels as opposed to indicator clues at levels. Or even worse, following indicators irrespective of trend, irrespective of longer term support or resistance, irrespective of multi-time frames. Does this make sense? Okay. And this is really the crux of my webinar. Okay. Are there any questions, guys? Because that's basically all I have. You don't need indicators. I'm just as happy without them. Well, Sanjay, what I said earlier was, okay, check it. Here, I'll show you what's up. Okay, and we'll use a little bit of hindsight here just for the benefit of this conversation. Okay, yesterday, I'm sorry, on Monday I had a 54.40 long in mind on the pound. It was this level based on this, right? Based on that. Okay? My pivot chart. Here's my pivot chart here. I have a few things on them. But like I said, guys, I can do away with these. The indicators, I like to have them on there because I've grown accustomed to having them. But if you said to me tomorrow, you have to do away with all of this stuff, it wouldn't be that big of a deal. All right, let me illustrate a point here, and let me illustrate a point here to Sanjay since he asked. Okay, here's my point. Okay, let's use this area specifically. All right, resistance now becomes support in the context of an uptrend, blah, 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 blah. And we'll take this off. We'll zoom in here a lot. Okay. Here. All right. Let's say you looked at this and you said, oh, it's a Audi double top. Guys, I really sincerely apologize if I missed your questions. Boyke, I found boot camp like 3 weeks after I started trading, but I was definitely motivated to learn what made sense to me. So I took some of boot camp, some of other stuff, some of just what made common sense appeal to me, and then applied that. And it's been an evolving, it's been something that's evolved. I think it's important, and I say this to you, it's so important you do what makes sense to you. All right, but Sanjay, here's the problem with following indicators. Okay, let's say you take this 5A cross as an entry. It looks okay in this context, but the issue is this, is that when this 5/8 is actually crossed, the candle is down here. Which is, if you take a fib of this rise, is in the green zone. It's got you short at precisely the wrong spot. Right? And even say something like this that bounces off here, and when this candle, comes off the support, which is where you want to be buying, when it comes off the support, when this candle's green, this 5/8 looks crossed. Okay? It's going to look crossed like this. And even we know that this continues up, but that is a terrible, terrible, terrible trade right there. Horrible. Why? Because that is potentially exactly where it's going to fail. So these moving averages are getting you in precisely at the wrong time. So the bottom line is identify your buy and sell zones, and then watch price action around those areas and wait for your oscillator, or wait for your indicators to complement them. Wait for them to be in line, ready to cross. Just like I'm saying today, right? What's our trade plan for today on the pound? Our trade plan for today, and I've got to run out of here in a sec, but our trade plan for today on the pound is this. This area, we're expecting that to basically get us short down to 55 here. Okay? So what I want to see is price doing this. Picture this as a 15-minute chart. I want it to look exactly like this. Actually, I'll do it on a 15-minute. Okay, so I'm expecting it to do a little something like this. Put our red zone in here. Why is this our red zone? We talked about that. It's the trend line. It's weekly reversal pivots. We extended. It's a move, fibula drop. It's previous resistance. It's the daily 200 EMA. Okay, so the 15-minute chart, I want to see look like this. Yeah, and naked trade all the time. I mean, that's basically what I'm doing. Okay, red. Shoots up green. Looking bullish. Exactly what you want to see to short. Hits your area, red. Shows an immediate little bit of green. The failure, it shows a little bit of high low green and an immediate little bit of red. I'm now short. The 15 minutes to get. Oh, dang it. Sorry. Okay, a little bit of high low green and an immediate failure red. Starts to show red. At the same time, oscillator does this. Hasn't crossed down, but it's trying to. Okay, this puts me short. Bang, lower high, red rollover, and maybe on the 5 minute, I'm watching this component of it. And on the 5 minute price action, I start to see something like this. Breaks a low and pulls back, which is this here. And I short that. And I put a stop up here. That to me is the fastest way of doing it. If I was going to wait for the moving average crossover, it would do this. And maybe price does this. And by the time I'm in here. And guess what? I'm in exactly at the previous resistance and fibula rise. And I'm in prime position to get smashed if I'm wrong and it continues up. Yeah, you can certainly play the upside to the zone. It's just getting skinny. I mean, if you consider the whole rise is this, if you consider the whole rise is that, say that's 100% of the potential rise. You're talking about trying to capture this. So this is the start point, and this is the finish point. You're trying to capture this part. There's nothing wrong with that. It's just, it's getting skinny. Make sense? So the meat of the trade now is starting to become, like there's more downside risk. I hate that term, but the meat of the trade is starting to become, the downside component of this is starting to look like this now. I like that. I like it to shoot a bullish engulfing into my areas. That's actually my preference. Because then all this dynamic moving average stuff below it isn't an issue and you can short back to it and then be like long break even by the time you even hit your first area of contention. Alright? Once again, I sincerely apologize if I missed your lesson, I missed your questions, but I hope you enjoyed today's webinar. If you have any further questions, david@fxbootcamp.com or @forexdavid on my twit is about the best way to reach me. Okay? Like part-time, Boyke. But I hope you enjoyed it, and good luck, everybody. Thanks.